You are being told that the market is correcting, that demand is still resilient. Welcome to Brickonomics. I am David Hayes, and I am here to tell you that it is a dangerously orchestrated illusion. The housing market warning light isn't just flashing red, it's a structural failure. What you are seeing is not a correction. It is a controlled demolition, and the blueprint is identical to every single crash in modern history. You are being told that this time is different because inventory is low. You are being told that demand is resilient. This is an illusion. The critical warning signs are not just present, they are accelerating. In the grand theatre of economic history, every boom and bust appears unique, yet this perception is a dangerous fallacy. When you examine the architecture of these events, the foundational mechanics are identical. Prices reach unsustainable peaks, and then, with startling velocity, demand evaporates. My analysis today is focused on one question. Why does this vanishing act occur? Why do mortgage delinquencies, the quiet poison in the system, begin their insidious rise even as mainstream analysis proclaims a hot market? And what is the profound collective calm, the pervasive sense of security that always precedes the fall? If you recognize these symptoms in the current environment, you are not suffering from paranoia. You are instead demonstrating foresight. This early recognition is a strategic advantage that could preserve your fortune. What follows is the anatomy of what always happens right before the unraveling. Chapter 1. The 3 Pillars of Market Stability. Fundamentally, the entire edifice of housing valuation rests upon 3 core pillars. While this may appear as a simplification, these are the essential forces you must monitor. The first is the cost of capital, encapsulated by interest rates. The second is the purchasing power of the populace, defined by prevailing wages. And the third, the most volatile, is collective consumer confidence, the shared belief in future prosperity. These 3 forces are not independent, they are the intertwined mechanisms that govern the complex ballet of supply and demand. Consider their mechanics right now, in 2025. Low interest rates, like those we saw from 2008 until 2022, function as a powerful accelerant. They increase demand by reducing the cost of borrowing, making larger mortgages feel comfortable. Simultaneously, they decrease available supply. As demand soars, existing owners are less inclined to sell, and investors, from Wall Street to individuals, enter the market to acquire properties, turning them into rentals and Airbnbs. The inverse, which we are living through, holds true. As interest rates climb, as the Fed has aggressively hiked them to combat inflation, demand contracts. But here is the critical 2025 nuance. This has not led to a flood of supply. Why? Because of the lock-in effect. Millions of homeowners are now trapped by their 2, 3 or 4% mortgages. They cannot sell because to buy a new home, even a cheaper one, would mean acquiring a new mortgage at 7 or 8%, potentially doubling their monthly payment. This creates an artificial supply shortage that masks the catastrophic drop in buyer demand. The second pillar, falling wages, exerts its own pressure. A decline in real inflation-adjusted income, which many are experiencing, directly increases supply at the margins as households find themselves unable to service their obligations. This is when delinquencies appear. Concurrently, this economic distress frightens the population, which eradicates new buyer demand. The final pillar, consumer confidence, is typically the last to shift. However, when it does, the entire market recalibrates with astonishing speed. We saw this velocity in 2008. We saw it again during the chaos of the early pandemic. That pandemic serves as a perfect, supercharged case study. The initial shock induced ultimate fear. Homeowners, terrified of impending wage loss, listed their properties. But this was countered by an unprecedented intervention, a nearly unlimited monetary expansion, which stabilized incomes via stimulus, combined with a monetary policy from the Fed that crushed interest rates to prop up the economy. This confluence didn't just stabilize the market, it ignited it. It drove demand for larger properties, fueled a wave of speculative investment, and consumed supply. This three-part pattern is not new. It is a rhythm that repeats. Chapter 2. The Unchanging Historical Blueprint. This pattern is a perfect echo of history. In the 1980s, soaring inflation prompted the Volcker-led Fed to raise interest rates above 17%. Mortgage rates became fundamentally unaffordable, housing starts collapsed and the market crashed. Shortly thereafter, the savings and loan crisis of the late 80s and early 90s, born of financial deregulation, fostered an environment of profoundly risky lending. Over 1,000 institutions failed, a credit crunch ensued, and the inability of wages to support the debt taken on contributed directly to the 1990 and 1991 recession. This pattern achieved its most catastrophic expression during the 2008 subprime mortgage crisis. This was not a sudden anomaly. It was the culmination of years of institutionalized risky lending. A widespread financial doctrine emerged, asserting that home prices were infallible. This belief fueled the creation of complex financial instruments built upon a foundation of subprime loans extended to borrowers with no verifiable capacity to repay. When this bubble of misplaced confidence burst, the ensuing wave of defaults initiated a global financial crisis, erasing 20% or more of home values and leading to a historic dispossession of homeowners. Even the recent pandemic boom and its correction follow the script. Extreme low interest rates fueled historic demand and a surge in prices. Those prices peaked in 2022. As interest rates were aggressively hiked, the market cooled instantly. The pattern is identical, only the specific catalyst for the shift in confidence changes. Chapter 3. Debunking the price-to-income myth. Given these cycles, we must analyze the indicators that foreshadow a crash. One of the most frequently cited metrics is the price-to-income ratio. A common heuristic suggests that when property values exceed 5 times median incomes, they are overvalued. I am telling you today to treat this metric with extreme caution. It signals a disconnect from fundamentals, but it is not an accurate indicator of an imminent crash. A far more precise metric is mortgage debt service payments. This is the key. When interest rates decline substantially, the monthly cost of owning a home also declines, even if the sticker price is rising. This creates new bandwidth for price appreciation. A general guideline, the 1% 10% rule, illustrates this. For every 1% reduction in interest rates, affordability increases by approximately 10%. This creates a 10% tailwind for housing prices as the borrowing capacity of the entire market expands. This is not theory, it is simple mathematics. If you study charts comparing the home price index against debt service ratios, the truth becomes clear. It is the substantial rise in mortgage debt service ratios that reliably precedes price corrections. There are moments, such as the present, where price-to-income ratios are historically extended, yet debt servicing ratios remain just within historical norms for those who already own. But for new buyers, the ratio has exploded, which is why demand has vanished. The percentage of monthly income required to service new debt is the significantly better indicator. Another signal is rapid price growth that vastly outpaces wage growth, especially during periods of flat interest rates. This signals an unsustainable trajectory, as charts tracking real household incomes, that is, income adjusted for inflation, demonstrate home prices are often a lagging indicator. When the real purchasing power of a population declines, it is a strong predictor that housing prices will follow suit 1 to 2 years later, as seen clearly in 2007 and again in the 2019 to 2021 period. Chapter 4. The canary in the coal mine. Among all predictive indicators, however, one stands as the paramount signal of systemic instability, the erosion of lending standards. This metric, more than any other, functions as the canary in the coal mine. When credit risk is aggressively embraced, it signifies that capital is being allocated to individuals demonstrably unable to service their debts. This is the precursor to an inevitable catastrophe. In 2008, this was obvious. It was the proliferation of subprime loans, the acceptance of negligible down payments, and the normalization of ninja loans, no income, no job, no assets. It included the widespread use of adjustable rate mortgages, or ARMs, which lured borrowers with low initial payments, only to reset catastrophically higher, ensuring financial ruin. This was the core mechanism of the 2008 crash. It is rarely the interest rates themselves that cause the crash. It is when mortgage debt service payments become unsustainable because of risky lending, which in turn causes delinquency rates to rise. The inability to pay the mortgage is the root of the crisis. Today the risk looks different, but it is just as present. We don't have ninja loans, but we had a 2-year period of speculative mania where people waived all inspections and bid hundreds of thousands over asking, financed by historically cheap debt. Now, look at the data. The Fed's own Senior Loan Officer Opinion Survey, or SLOOS, shows banks are aggressively tightening lending standards for all forms of credit. They are slamming the brakes. Simultaneously, delinquency rates, while low overall, are ticking up precisely where you'd expect, in FHA loans, in VA loans, and, most alarmingly, in credit card and auto loans. This is the first crack. It shows the consumer is tapped out. Chapter 5: The Global Contagion and the CRE Bomb. It is crucial to understand that the national housing market is a statistical abstraction. It is a collection of disparate markets, but more importantly, no market is an island. What we are witnessing is a global phenomenon. Look at China. Its entire economic model was built on real estate, and it is now collapsing under the weight of Evergrande, Country Garden, and dozens of other developers. That is a demand and overbuilding collapse. Look at Canada or Germany. They are experiencing severe corrections because their markets are based on short-term, 5-year fixed loans, which are essentially adjustable rate mortgages. As those loans reset at much higher rates, the payment shock is forcing sales and crushing prices. In the US, the unique risk is commercial real estate, or CRE. The work-from-home revolution has left office towers empty. These multi-billion-dollar loans are coming due, and they cannot be refinanced at current rates with current occupancy. This is a slow-motion default wave that will cripple the balance sheets of regional banks. And which banks finance the majority of all residential construction and small business loans? The regional banks. A CRE crisis is a residential crisis in disguise. It chokes off the credit needed to keep the system functioning. Chapter 6: Your Financial Fortress. Given these cyclical certainties, how does one prepare for the inevitable correction? The doctrine is simple, and it is defensive. First, always buy within your means. Avoid stretching your finances. Grant yourself a significant buffer for job loss or recession. Second, avoid speculative buying. The worst time to acquire investment real estate is when it is the subject of popular mania. The best time is when prices are falling, but that is precisely when fear prevents action. Third, focus on affordability and personal needs. Resist the allure of the McMansion for a smaller, more affordable property that will not precipitate a financial crisis when the economy turns. If you cannot comfortably afford the home you believe you need, do not force the purchase. Wait. Furthermore, it is essential to utilize sound financial instruments. For the American audience, the 30-year fixed-rate loan is a unique and powerful tool. It provides stability and protection from rising rates. It is the antidote to the ARMs and 5-year terms that are destroying other markets. Stable, long-term payments that you can afford even with a 15 or 20% drop in income are the key. This strategy must be paired with financial resilience. Build an emergency fund of 3 to 6 months of expenses. Aggressively reduce high-interest debt, especially credit card debt, which should be your highest financial priority, and crucially, diversify your assets. Avoid the catastrophic mistake of concentrating your entire net worth in real estate. Maintain a balanced portfolio of stocks, bonds, and cash. If the real estate market crashes, your other investments may provide a necessary hedge. Ultimately, you must hope for the best while meticulously planning for the worst. Be conservative in all future assumptions regarding both your future income and the trajectory of markets. The most common financial mistake is building a plan based on the expectation that conditions will only improve. They do not. A conservative projection is the only defense against the next recession, which is no longer a distant possibility, but a looming probability.